So good afternoon, everybody. Welcome to our webinar series, special webinar with regards to the recent levels of China volatility. My name is Jonathan Wu, and I'm the Associate Director and Head of Distribution Operations for Premium China Funds Management. So what we want to go through today with everyone is with regards to the recent levels of volatility that's occurring in China, to provide you some context and also give you an update on our funds in light of the current levels of market volatility. So our standard disclaimer with regards to the nature of the information we provide today is of a general nature, as no specific advice is being provided. So obviously, at the end of the day, the current levels of volatility we're seeing in the Chinese equity market is, firstly, it's not unprecedented, where a lot of people have said that we haven't seen the likes of this level of volatility in China before. The simple answer is that we continue to see volatility through a lot of the reform measures that the Chinese government has been undertaking over the course of the last couple of years. And ultimately, one of the things is through volatility, you can start to see value, depending on the market, and they're very stock specific in the way that you manage money, such as the like of our funds. And we just wanted to remind everyone that volatility itself is not a bad thing. It's what you do about the volatility that makes all the difference. So let's provide some context for everyone with regards to what's happening and what's the kind of state of affairs now with regards to market valuations. So this is a slide that we put up at every one of our webinars or roadshows. For those of you that attended our most recent national roadshows in early August, you would have seen this chart for the end of July. What's interesting now is that if we look at the chart ending August, you can see that the China H market is incredibly cheap. We're looking at around 6.8 times as of now, with even the Chinese A-share market also clawing back now, and it's now become cheaper than Australia with only just above 15. With the last couple of days of volatility, we've seen the market come off slightly further. And you see this is a global phenomenon with regards to what is relatively of value. And as most of you know, most of our holdings are in Hong Kong for the China Fund, the Asia Fund and the Asia Property Fund, which means that the valuation set that we're facing in amongst the levels of current volatility also prove that for us long-term wise, the A-share market and the Hong Kong market is the place where you want to be. So again, putting things into context, let's consider the level of volatility we see today versus the level of volatility we've seen in previous times. As you can see here, over the last 25 years, there have been more than 25 mini crashes. We define mini crashes as those that have seen the market drop in excess of 20% from its peak. And as you can see here, over the course of the last 25 years, the current length of the correction in the Chinese market is at 35 days, and it ranks as actually only the 18th worst mini crash in the last 25 years, with even the GFC ranked at the fourth weakest crash, which caused the market to drop almost 50% over the course of 125 trading days. So in light of this, we are not too concerned. The thing that we are seeing is that the confidence is fragile within the Chinese market. And in the very short term, we see that the market will remain very volatile. But the difference that China has compared to the rest of the world is that it can and will support, and it has its own market rescue fund, which was announced a fair while ago, and that's being financed by a Chinese Securities Finance Corp, which is an SOE, and they put a lot of different other rules in place to control broking houses and the like. And so the market rescue fund in this particular instance is around 5% of the total market cap. If we compare these against other Asian rescue funds we've seen, back in the Asian financial crisis, Hong Kong had one about the size of 6%, and South Korea in 1990 had one of the size of about 5% of market cap. We definitely don't have an issue with any form of market intervention. It is natural in any market that has lost a level of stability for the government to step in. And this is no different from the United States launching QE, which is ultimately market intervention, as well as Hong Kong with its stabilization fund in 1998. What has probably come to a head, though, is actually it's given the Chinese central government a further wake-up call with regards to the increased need to push forward with their reforms to actually stabilize market, but not only stabilize the market, but also be able to push forward with their reforms, and noting the urgency at which they need to do so to provide further confidence to the market in light of the current levels of volatility. So as I mentioned just before, that market intervention in other countries is nothing new, with Hong Kong having one that was there for about 5 years, and the Fed running 3 bouts of QE, with the tapering finishing up over the course of almost a 6-year period. So when we see market intervention come into play, both of these we have seen have been quite successful in the sense that they had a market stabilization effect. It had an effect of confidence back into the market, and as the rescue funds slowly withdraw from the market, naturally the market has taken over to be the driving force behind it going forward, which is very good to see. And so we see this is no different as what's happening inside China, if not more, even more confidence in the fact that it is a command capitalist economy with a lot of levers to pull and an ability to be able to mobilize decision makers and mobilize funds to where it's most needed at its most crucial time. One of the things that we do look forward to ultimately, though, is we want to see the Chinese markets develop to become more mature, and as a part of its maturity phase, one of the things that we're going to see is that the percentage of market cap to GDP will increase over time. One of the things that we spoke about at our recent roadshows was about those SOE reforms, about these SOEs companies that over time do need to list and put placements in the market, which will provide further market cap and market depth expansion. And through this, as you can see here at the moment, that the market cap to GDP is about 80% compared to places like the US or Japan, which are both above 100%. China still has a way to go to achieve this, and with GDP growth still growing reasonably well at wherever you want to assume it to be, at 5, 6, or 6.5%. We certainly see that there's a lot of potential for the market to grow, the depth to increase, and ultimately for the government to have a larger proportion of the investable money coming from institutions as opposed to the retail investors. We're very glad to see that this time round that the market has responded well from the perspective of having a lot of these retail investors being wiped out. These are the investors that ultimately caused the original levels of volatility in the market. A lot of the margin lending has been clamped down upon, and so this natural correction, especially in the A-share market, has allowed more institutions to enter the market. You're going to see the further reforms with the Shenzhen Hong Kong Stock Connect, which will expand the universe of stocks by about 3 times from the original 200 stocks that the Shanghai Hong Kong Stock Connect allows, which will expand to over 700 with the Shenzhen Hong Kong Stock Connect sometime over the course of the rest of 2015. And you'll see these reforms develop to a level whereby institutions will stabilize the market naturally, because it's not a matter of whether or not people want to get into China, it's when people want to get into China. And we're still of the strong belief that through all these different market reforms that are still going on, as the market stabilizes, you want to really consider getting in at a lower point. And I'm going to show you these valuations now for the market. If we consider the MSCI China Index, on the left-hand side chart, you can see this is at the end of, or very late into August. You can see that over an average period of the last 10 years, the MSCI China Index, which is made up of Chinese companies in Hong Kong, has traded at an average PE of about 12 times. Today, that index is trading at just a minuscule amount above its 1 standard deviation below its 10-year average at 8.5 times, whereby the standard deviation is at 8.4. So we certainly can see that there's a lot of opportunity here. From the perspective of price to book as well, you're effectively getting a fair valuation at 1 times, which is which is also now below the below 1 standard deviation of the 10-year average, which has been about 1.8 times. So we're kind of in that condition currently, whereby actually it's a little bit lower than where it was before the market rallied in July 2014, which allows everyone to consider where their exposures want to be going forward. If we look at the Hong HSCEI, which is the Seng China Enterprises Index, we paint also quite a similar story, where you can see that the the PE levels are about 6.8 times, which have come off significantly off that almost 10 times mark prior to the recent levels of correction. The 10-year average is at 10.7. And as you can see here, it's also below 1 standard deviation against the 10-year average. Same thing applies for the price to book. It's also at 1 times, and there are very, very few markets that, despite this recent level of volatility, is trading this cheaply. And so hence provides another opportunity for investors to consider getting in for a long-term story. We have to consider that ultimately that the investors' worries are switching from the stock market itself, because it's already come off quite significantly, to the broader economy. And so you've had Chinese growth in the first half of the year. The growth rate was incredibly weak, and this is despite having a property market that's been recovering quite strongly, coupled with the fact that you have very weak exports. There was a recent devaluation of the yuan back in August, and this is where the whole global jitters was compounded against what occurred earlier in July and in June with the market volatility. Investors, as through every other crisis you see, have overreacted, and we certainly believe that economic growth will restabilize through the current devaluation, which does make Chinese exports a bit more a bit more competitive. But behind the scenes of that, China's economy is moving towards a services-based one, internal consumption, and these are not captured as part of the quality of GDP growth. This is just captured as part of a gross number. China ultimately still has a fair bit of ammunition left in its kilter to implement big stimulus when you compare it against the rest of the world, with both the Eurozone and the United States having near zero rates. So through a lot of monetary stimulus, where we've seen the Chinese government either cut rates or cut the RRR ratio, this has been ways for the government to utilize monetary policy to put more liquidity in the market, to support the market. And we'll continue to see, and you should continue to expect to see further rate cuts to keep stimulating the market. You have to keep a well-diversified portfolio, especially when you consider the valuation set that China offers now against other countries. And we're presented with the same or very similar case to what we saw in the middle of last year. So while China does have the capability to save itself this time around with quite strong levels of ammunition, it's certainly we don't believe that it can save the rest of the world if we were to face down the barrel of another crisis. So with that in mind, if we have a look at the latest figures that's coming out of our funds. You can see here these are the official headline figures, comparison figures for the Premium China Fund as at the end of July. So this was the second straight month where the fund lost around 9-ish% against the benchmark that lost slightly less for the month. And the sole reason for that is because we do still hold a portion of the portfolio in A shares, what you can see there. At that point in time, the fund was fully invested, and as of today, the fund is about holding around 10% cash. The negative 5% cash there is actually a funding mechanism for fees and redemptions, mostly fees for for the coming period. As you can see there, there's also outstanding trades that were part of the portfolios that were selling down, part of the stocks that were selling down, which have caused the cash to go into a negative position. But right now it's about that 10% mark. So with this recent correction that's come through, the fund has still performed strongly over the 1 year, outperforming the benchmark by about 500 points and up about 32%. And the annualized return is still at about over 12%, which is still very strong over the last 10 years. To give you an update, for the month of August, the fund retracted another 10.5% net, and that was the highest level of volatility that we've seen for quite a long while. With the Premium Asia Fund, this has had the benefit of being unhedged. With the Australian dollar coming off over the last few months, this has cushioned some of the losses on the fund, as well as this has held slightly more diversified with South Korea and a splattering Singapore and Thailand, Malaysia and Indonesia. So you can see here that for the 1 month ending July, the fund lost 6.7%. For the month of August, it lost a total of 7%. So you can see that being in Asia this time round has shielded some of those negative returns. With the annualized return still sitting at 13.2% against a benchmark of under 10. These are all net of fee figures. This is obviously still provide a very attractive offering into Asia. For those of you in our Asia Property Fund, you can see that the figures are somewhere in between where the China Fund and where the Asia Fund has played out. Cash has been raised on this portfolio now as well, getting close to about that 6 to 7% mark, with the 1 year figure still at about 23% net of fees, despite the current levels of market volatility and market correction, which was certainly expected, given the fact that A shares had run simply so hard over the last 12 months. And finally, with our Asia Income Fund, as you can see here, that for the 1 month ending 31 July, the fund was still up 1%. For the month of August, it's actually down 2.4%. Which makes the year up around 6% for the total, which is still a very strong offering. And the fund is still paying solid distributions with an annualized return of 11.6% net of fees. So this is certainly this fund has been shielded. The current hedging level of this fund is at 50%, which is the minimum, which allows a little pickup on the carry, but it's also effectively been able to break even against what's happened with the Australian dollar. So that's all the time that we have today to discuss the market volatility. Just wanted to provide a quick summary to everyone in the market. If you have we actually have an attached document that you can provide to clients with regards to the current levels of volatility, and also again revisits the current situation that China is facing. Feel free to follow the links that we're providing via email to download that document, and by all means please contact us if you have any questions, either your state manager or or our advisor services line on Sydney 02 921 13888. But thank you very much for your attention, and hope everyone has a great afternoon. Thank you.